If you are married or in a common law relationship and one of you has more pension income than the other, there is a strategy sitting in the Canadian tax code that most couples either use wrong, use partially, or do not use at all. And the ones who miss it are not just leaving tax savings on the table. They may be handing back a portion of their OAS pension every single month for the rest of their retirement. That is the part almost nobody talks about. Pension income splitting is covered as a tax strategy. The way it connects to your old age security is the piece that gets left out of the conversation. Today we are going to cover both. Exactly how pension income splitting works, what income actually qualifies, how it directly affects your OAS, and where to look to find out whether your current plan is protecting everything it should be. If you are not subscribed yet, do that now and turn on the bell. These rules are adjusted by the CRA every single year. When the numbers change, most couples find out at tax time, when the opportunity to act has already closed. That is exactly what this channel is here to prevent. Let me start with what pension income splitting actually is, because there is a version of this that circulates out there that misses the most important part. Most people understand it as a tax savings move. One spouse has a larger pension, the other has less income. You shift some pension income from the higher earner to the lower earner on paper. The household pays less total tax because Canada's progressive tax system charges higher rates on higher income. That part is true, and it matters. But pension income splitting is not just about tax brackets, and the OAS connection is where the real money often lives. Here is how the mechanics work. Under the Income Tax Act, married or common law couples can jointly elect to allocate up to 50% of eligible pension income, from the higher earning spouse to the lower earning spouse. You do this using CRA Form T1032, the joint election to split pension income. Both of you sign it, both attach it to your respective returns. Both must file it by the return's due date. No money actually moves. Your pension still flows into the same account it always did. The only thing that changes is how the income is reported on each person's tax return. The transferring spouse deducts the allocated amount on line 21,000 of their return. The receiving spouse adds that same amount on line 11,600 of their return. That is the entire mechanical transaction. One form, two signatures, two line entries, and the household's combined tax picture changes completely. Now let's talk about what income actually qualifies, because this is where people get it wrong and end up thinking they cannot use this strategy when they can. For anyone who is 65 or older at the end of the tax year, eligible pension income includes payments from a registered pension plan, withdrawals from a registered retirement income fund, or RRIF, life income fund payments, and RRSP annuity payments. That last one is significant. Your RRIF withdrawals qualify for splitting once you turn 65. If you have not started a RRIF yet and you are 65 or older, even converting a small amount of your RRSP to a RRIF and taking a withdrawal of as little as $2,000 can open the door to pension income splitting and to the pension income tax credit at the same time. For anyone under 65, the rules are narrower. Generally, only life annuity payments from a registered pension plan qualify. RRIF withdrawals do not become eligible until age 65. Here is what does not qualify for pension splitting, at any age. CPP payments are not eligible under this rule. There is a separate CPP sharing provision through Service Canada for that, which is a different program entirely. OAS payments themselves are also not eligible pension income for splitting. That point matters, and I will come back to it. Now here's where this conversation has to go deeper than what most people have heard. The OAS clawback, officially called the Old Age Security Recovery Tax. For the 2025 income year, which affects your OAS payments running from July 2026 through June 2027, the recovery threshold is $93,454 of net world income. For the 2026 income year, the threshold rises to $95,323. Once your net income on line 23,600 of your return crosses that line, the CRA begins recovering 15 cents of OAS for every dollar above the threshold. The recovery does not arrive as a lump sum at tax time. It is deducted from your monthly OAS payments throughout the following year. A quiet monthly reduction. Invisible until you look carefully at your deposits. If your income sits at $110,000 in a given year, you are $16,000 or so above the threshold. 15% of that is roughly $2,400 in OAS recovery. That is $200 less in your account every single month for 12 consecutive months. And the clawback does not care whether that excess income came from a workplace pension, from mandatory RRIF withdrawals, from capital gains on investments, or from eligible dividends with the 38% gross up that inflates your line 23,600 figure beyond your actual cash received. What matters to the CRA is one number, line 23,600, your individual net income. And this is where pension income splitting becomes something larger than a tax bracket play. The OAS clawback is assessed individually, not on combined household income, on each person's income separately. That single fact is the entire opportunity. If one spouse has a net income above the threshold and the other has a net income well below it, pension income splitting shifts income from the spouse who is losing OAS to the spouse who has room to absorb it, without triggering a clawback of their own. Think through what that means in practice. A spouse with net income of $110,000 is losing OAS. Their partner has a net income of $50,000. The clawback threshold for 2026 is $95,323. If $20,000 of eligible pension income is shifted from the higher earning spouse to the lower earning one, the higher earning spouse's net income drops to $90,000. That is below the clawback threshold. The OAS clawback disappears entirely for that spouse. The receiving spouse moves from $50,000 to $70,000 in reported income, still well under the threshold. Their OAS, if they receive it, is fully protected. The household loses no OAS from either person, and the combined tax bill is lower as well because the income is now distributed more evenly across two returns. One form, both signatures, and the family keeps thousands of dollars that would otherwise have quietly left their account month by month for the following year. Here is why this particular connection gets missed. Most people only look at pension splitting as a tax strategy. They run the numbers once. They see whether it pushes each spouse into a lower bracket. If the saving is meaningful, they file the form. If they happen to be in the same bracket already, they might conclude it is not worth it. But that calculation almost always ignores the OAS layer. Even if both spouses are paying tax at the same marginal rate, pension splitting can still be worth doing if it pulls one spouse's net income back below the clawback line and restores their full OAS. The restored OAS is not a tax credit. It is real money that was being deducted from your monthly deposit and is now staying in your account. And there is a compounding issue here that makes the timing matter more than most people realize. The clawback applied to your July to June OAS payments is based on the previous year's income, which means the decisions you make this calendar year are going to show up as reductions to your OAS payments starting next July. Once a year is closed and the income is locked in, there is no retroactive fix. The clawback runs for 12 months. Then the next year's income determines the next 12 months. The window to act is always the current tax year, and the form has to be filed with your return by the due date. There is one important limit to understand clearly. You can allocate up to 50% of eligible pension income, not more, and you choose the percentage each year. You are not locked into the same split year after year. The T1032 is an annual election. You can use 30% one year, 50% the next, 15% the year after that, depending on what each year's income picture looks like. That flexibility matters because retirement income is not static. Mandatory RRIF withdrawals increase as you age. Capital gains can spike in years when you sell assets. Part-time income, rental income, eligible dividends with the gross up, all of it moves line 23,600 every year. The optimal split percentage in a given year depends on where each spouse's income lands before the election is applied and how far either of them is from the OAS threshold. Most tax software in Canada, including TurboTax, Wealthsimple Tax, and H&R Block, will model pension splitting automatically and show you the combined tax result at different percentages. Some will optimize it for you. If you are filing paper returns, Form T1032 is available directly on the CRA website at canada.ca. Both spouses complete it, both attach it to their returns. The transferring spouse enters the deduction on line 21,000. The receiving spouse enters the addition on line 11,600. If you missed pension splitting in a prior year, there is a provision in the CRA rules allowing you to request a late or amended election under certain circumstances, but only if the application is made no later than 3 calendar years after the filing due date for the year in question. That window is real, but it is finite. It is not a reason to wait. It is a reason to confirm that past years were handled correctly. There is one more piece of this to address before we talk about your action steps. If your spouse does not have any eligible pension income of their own, pension splitting does something else beyond protecting your OAS. When you split eligible pension income to a receiving spouse, the income retains its characteristics for credit purposes, which means the receiving spouse may become eligible to claim the pension income amount credit on the first $2,000 of the income allocated to them, provided they meet the age or income type requirements for that credit. A household where only one person has pension income could be claiming the pension income credit once. After pension splitting, depending on the ages involved and the type of pension, they may be able to claim it twice. Federally, the pension income amount produces a non-refundable credit on the first $2,000 of eligible pension income. Every province also has its own version stacked on top, 2 credits from one election. On top of the tax bracket savings, on top of the OAS protection, your action steps are straightforward. Step 1 is to look at each spouse's net income on line 23,600 from the most recently filed return. Compare that number to the OAS clawback threshold for that year. The CRA updates these on their website at canada.ca under the Old Age Security Recovery tax page. If either spouse is above the threshold, or close to it in a way that a strong year could push them over, pension splitting deserves a close look before the current year closes. Step 2 is to identify your eligible pension income. If you are 65 or older, RRIF withdrawals qualify. Life annuity payments from a registered pension plan qualify. CPP does not qualify under this rule, and OAS does not qualify. If you are not sure what qualifies from your specific income sources, the CRA's pension income splitting page at canada.ca provides a complete list organized by age. Step 3 is to have someone model the split percentages. If you are using tax software, it will do this for you. If someone prepares your return, ask them specifically to model pension splitting with the OAS threshold in view, not just the tax bracket comparison. Those are 2 different calculations, and one of them is commonly skipped. Step 4 is to make sure both forms get filed and both returns reflect the election. The T1032 cannot be filed by only one spouse. It is a joint form. It requires both signatures. Both returns must reflect the allocation. If only one return shows the election, the CRA will not accept it. Here is the one thing I want you to carry out of this video. Pension income splitting is presented as a tax strategy, and it is one. But the OAS piece is not a small footnote. For a household where one person's income sits close to the threshold, the value of splitting can be almost entirely about what it protects rather than what it saves in brackets. A spouse at $105,000 in net income is losing roughly $1,750 a year in OAS. A 30% split on $30,000 of eligible pension income shifts $9,000 to the lower earning spouse. Net income for the higher earner drops to $96,000. Still above the threshold, but the clawback is now $395 instead of $1,750. That is over $1,300 recovered from a single election that took 15 minutes to file. And if the split is larger, say 50% on $30,000, the higher earner's income drops to $90,000, below the threshold. The clawback is gone. One form eliminates it completely. The OAS clawback is assessed on individual income. Pension income splitting directly reduces individual income. The connection between the two is not complicated. It just does not get explained that way. Now you know. If this video helped you see something about your own retirement picture that was not clear before, please send it to one person in your life who is married or in a common law relationship and collecting a pension or drawing from a RRIF right now. Because the couple most likely to miss this is not the couple that does no planning. It is the couple that does their return every year without anyone ever asking whether the OAS threshold was part of the pension splitting calculation. That one question, asked at the right time, is worth real money every year for the rest of retirement. That is what the Maple Ledger is here to do. See you in the next one.